Right now, something unusual is happening in the markets, and most investors are only seeing the surface, not the signal. Gold, silver, even Bitcoin, all moving down sharply, not slowly, not quietly, but fast enough to make people uncomfortable. And whenever prices move this fast, the real question isn't, what just fell? The real question is, why did money start moving in the first place? Because this isn't random. This isn't panic out of nowhere. And this isn't about fear alone. This shift is tied to expectations, to policy direction, to how investors are reading the future of interest rates, the US dollar, and the overall economic environment. For long-term investors in the United States, this moment matters. Not because prices dropped, but because behavior changed. When assets like gold and silver fall after years of strength, it tells us something about confidence, about perceived stability, and about where capital believes opportunity may exist next. This is not a time to react emotionally, and it's definitely not a time to chase headlines. It is a time to understand how experienced investors think, how portfolios are adjusted during policy transitions, and how uncertainty can quietly turn into opportunity for those who stay disciplined. So before making any move, before buying, selling, or freezing in fear, you need clarity. In this video, we're going to break down what's happening right now, why markets are responding the way they are, and most importantly, how an investor can navigate this environment intelligently, without panic, without politics, and without guessing. Stay with me. Because what matters most isn't the drop you see today, it's the decision you make next. To understand what's happening right now, you first need to understand how investors read signals, not headlines. Signals. In the United States, one of the biggest signals for markets has always been expectations around interest rates, liquidity, and the future direction of monetary policy. Gold, silver, and even Bitcoin are not just assets people buy for growth. They're assets people turn to when they're unsure about currency strength, inflation pressure, and economic stability. For several years now, gold and silver have outperformed expectations, and in certain periods they've even outpaced traditional stock market returns. That doesn't happen often. Historically, when precious metals outperform stocks, it tends to show up during moments of stress, periods where investors are more focused on protection than aggressive growth. And we've seen this before. During the Great Depression, during the inflation-heavy 1970s, during the early 2000s tech bubble collapse, during the 2008 financial crisis, and again in the years following the pandemic. Each time the story wasn't about excitement, it was about caution. In recent years, concerns around government spending levels, expansion of the money supply, and long-term inflation risks pushed many investors toward assets that historically hold value over time. At the same time, central banks around the world, including major global economies, have been increasing their gold reserves, which added another layer of confidence to the precious metals trend. But markets don't move only on history. They move on expectations of the future. And one of the biggest expectations recently has been uncertainty around future leadership and direction at the Federal Reserve. The Federal Reserve plays a central role in guiding interest rate policy, managing inflation targets, and maintaining financial stability. When investors sense uncertainty about how aggressively rates might be cut, or how much liquidity could be added or removed from the system, they adjust positioning before changes actually happen. That's exactly what we saw. For a period of time, markets were pricing in the possibility of very aggressive rate cuts, stronger stimulus measures, and looser monetary conditions. Those expectations supported higher prices for gold, silver, and alternative assets. But expectations can change quickly. Once investors received clearer signals about potential leadership direction and a more balanced approach to rates and inflation control, confidence shifted. Not confidence in growth disappearing, but confidence in stability returning. And when that happens, protective assets often cool down. This is why the recent pullback was sharp, fast, and emotionally charged. Not because the long-term story disappeared, but because short-term assumptions were adjusted. For investors, this is where discipline matters. Market pullbacks don't automatically mean something is bad. And price rallies don't automatically mean something is safe. They mean expectations are being recalibrated, and the investors who succeed long-term are the ones who recognize that market cycles are normal, policy transitions take time, and reactionary decisions often cost more than patience. Markets don't wait for decisions to happen. They move based on what they expect is coming next. And one of the biggest drivers behind expectations right now is how investors interpret leadership direction inside the Federal Reserve. The Federal Reserve isn't just another institution. It directly influences borrowing costs, liquidity in the system, and how easy or difficult it is for money to flow through the economy. For months, investors were positioning themselves around the idea of extremely low interest rates, looser financial conditions, and more stimulus entering the system. When that expectation is strong, assets that protect purchasing power tend to rise. Gold benefits, silver often moves even faster, and Bitcoin, while different in nature, often reacts as a risk-sensitive asset when liquidity expectations change. But recently, those expectations began to cool. Not because rate cuts are off the table and not because growth is suddenly in danger, but because investors began to believe that inflation control and monetary balance would remain a priority. When markets sensed a more measured approach, one that considers lower rates without losing control of inflation, and without overwhelming the system with excess liquidity, confidence shifted. And when confidence shifts towards stability, money starts rotating. Some capital moves away from protection-focused assets and toward traditional investments that perform better in steady environments. This doesn't mean gold or silver failed. It means the role they were playing temporarily changed. Another factor investors pay close attention to is momentum behavior. When prices rise quickly over a short period of time, especially in assets like silver, they attract speculative money. Some investors enter late, not because of fundamentals, but because of fear of missing out. And when momentum slows, those same positions unwind fast. That's why pullbacks often feel aggressive, even when the broader economic picture hasn't dramatically changed.